everyone, my name is Samira and today we are going to talk about business costs, revenue and profit. Today is all about calculation, so please have a pen and paper beside you. Okay, let's start. So first we will talk about fixed costs. Fixed cost is a cost that will never change even though there is an increase in quantity, like the amount of water on earth. Even though the human population is increasing, the amount of water on earth is still the same. Okay, so this is a fixed cost graph. It is horizontal. So according to the graph, even though the number of tacos are increasing, the price is still 1.9. Okay, so this is fixed cost. Now variable cost. The change in price when there is a change in output produced. Example, if people are buying more, the price will decrease. Over here, the price is a variable cost. So variable cost is a linear graph which is calculated by standard variable cost into quantity. So standard variable cost means if there is a standard price for 500 grams of sugar is $1, and per extra gram there is $0.20 extra. So we say the variable cost 500. So the minimum you should buy is 500 grams and the fixed cost for that is 1. So 500 times 1, which is 500. And this graph is a linear graph. It's going upward. So as the quantity increases, the price also increases. So next, total cost. Total cost, the total expense incurred in reaching a particular level of output. Total cost can be calculated by total fixed cost plus total variable cost. Next, average cost and its curve. Average cost is the cost per unit of output. It is calculated by total cost divided by quantity produces. So if there is a question, calculate the average cost per unit for the firm when it makes 2000 units. You are advised to show your working. So in exams, they will ask this type of questions and they will give you a graph. So the average cost, total cost by quantity produced, and then the formula for total cost, total fixed cost plus total variable cost. Since they already gave it here, so this is not very necessary. The total variable cost is 4760. Now 4760 total variable cost plus total fixed cost, which is 7340, gives you 12,100, which is the total cost. Now average cost when you calculate, so the total cost divided by quantity produced, so which is 2000, the quantity produced, and the average cost is $6.05. This calculation can be represented on a graph as well. The average cost curve is U-shaped, which means as output increases, average cost starts to fall at first, reach a minimum point, and then it starts to rise again. The average cost curve is the same as the curve in economies of scale and diseconomies of scale. So after they reach a particular point, their costs will increase again. So it will rise. So as you can see, it is a U-shaped curve. So after this particular point, it started to make its curve upwards again. This is the average cost and its curve. Next, total revenue. The amount of money the firm receives after selling its output produced. Total revenue is equal to quantity into price. If the quantity produced is 60,000 and the price is $20, the revenue will be 60,000 into 20, which is $1,200,000. So this is total revenue. Now profit. Profit is the remaining money after all the expenses like tax and rent are cut off. So profit is equal to total revenue minus total costs. So if total revenue is 1,200,000 and the total cost is 30,000, profit will be 1,200,000 minus 30,000, which is 1,170,000. So this is profit. Till now, our chapter is finished. I hope you understand this chapter. Please be very careful with the formulas. These all formulas are interrelated to each other. So like if you see in average cost, you can't calculate average cost until you know the total cost. So how do you calculate total cost? Total cost is total fixed cost into variable cost. How to calculate variable cost? Variable cost is equal to standard variable cost into quantity. So these are all interlinked with each other. So please be very careful with the formulas. I hope you understand this chapter. See you next time. Bye bye.